Mic check.
Yo.
Gotcha.
Nice. Morning again. I want to have one of these notepads beside me. Okay, here we go. So, review. Zoom logic. So again, apologies, guys. Are kind of what do you call this? Not in my usual comfort zone. Usually, we just hop on around about 8, but like I said, I was nowhere near home, so I didn't get to write out the agenda, and yeah, so I'm real quickly making a list of a few things that I want to get out on the call, so I don't run away with the convos. Bam, bam, bam. So while other persons are hopping on, I'll just do that right now. Start with this and this. Let's start with this. And a little bit of this. And a little bit of this. Okay. 1, 2, 3. That would do. Let's see what's in the chat and then we could get started. So, morning again, everyone. And let us quickly walk through reviews, expectations, what happened, plans for next week, all that good stuff. So last time we spoke about a daily chart, I believe we were looking at this guy being our order block, range high being traded up. We need to see this order block get invalidated. We could see how it hit here, rejected, week open with a big gap right through FEG. No worries. The expectation last week before the week started was that we would see this act of support if we're getting that high taken, and then beautiful. Didn't act as support. We gapped through. Big Monday. All that good stuff. Monday not being the high of the week. Beautiful. Traded higher yesterday. Really felt like that was the bullish intent, and then it failed aggressively. So with this in mind right now, the FOMC interest data suggests to us that buyers will be coming in the market. Why I'm saying that is interest rate was cut. So if we do this real quickly, this is how I interpret the interest rate information. We have the central bank right here. And then we have the other banks right here. And then we have the investors over here. So pretty simple. These guys over here controls a big part of how much money goes into that. Okay, so if these guys, the central bank, are putting interest rate lower, it means the other banks have less money to pay back on loans. Now, anybody with a little bit of financial understanding, if you're getting a loan at a lower rate, you're more inclined to take loans, which means the money supply here is going to increase. If there's more money available, and there will be more eager and willing to lend to investors. Now, if investors have a whole lot of money, they're going to do what investors do, which is to invest, buy and hold, not scalp or trade. Buy and hold. That's what investors do. So anytime interest rate data goes down, increases the money on both ends, investors buy and hold stuff, which means stock markets do that. All things remaining equal, right? No brand new AI kicking away people and all that. Somebody pointed to something here, and it's gone now. Risk off. Risk off is when investors feel less inclined to take risk. Risk on is when they feel more inclined to take risk. When they are more inclined to take risk, they spend more. When they don't feel inclined to accept risk, then they keep their money. So horrible. Risk. So let's say R on. Risk on. They take risk. They spend money. Market do that. Risk off. They don't spend money. Markets do this. Now, intuitively, it might seem like, why wouldn't it be the other way around? But I'll tell you why. With the risk on, most of the money that they're spending goes out of the economy. Not a whole lot of risk that's taken gets put into the economy, because the percentage on returns generally goes down with interest rates dropping. So they seek external investments. When external investments are interesting or appealing, the dollar gets weaker because money is coming out of the economy. If the dollar gets weaker, what happens? Stock markets go up. And it sounds counterintuitive. Stock markets go down when nobody's spending money and the dollar goes up. So just a little bit of for the guy who put risk off right there. So let's tidy up all of this and then get back to work. So yeah, that's the risk sentiment right now. Persons want more money to spend. What they're going to do with that money, we don't know yet. Fundamentals or commodity markets are going to point to appealing markets, but I don't know what those are yet. Quite possibly it should be gold. Gold is the best hedge against everything. So I would argue that gold should be reaching 3,000. Yeah, I would argue that gold is going to reach 3,000 under this economic climate, which means the dollar is not reaching here. The dollar is going to go down, which means, again, everything else is going to do the opposite, right? You'll see. You will see. So on the daily chart, everything now is potentially a big stop run. So getting back to the good stuff. With that being said, if whales are going to be accumulating positions now, for the week coming, daily lows are on the menu. Have to be. Daily lows have to be on the menu. So the first daily low we're going to be interested in is Thursday's low. Assuming that we open with a gap. I'm not sure what causes. I think it was the tariff announcement that caused all of this. But daily lows should come on the menu. And I don't want to get too optimistic and say all the way down here. I'm going to say this first. If this, then that. If this, then that. They have equilibrium right here, bullish order block. It's opening the door for big higher time frame accumulation. So don't commit to being bearish or bullish right now. Just accept that this climate right now, investors are in a frenzy. There's a whole lot of money to be made. And right now, persons are positioning themselves for the bull market. The bull market, that's what I think. In a perfect world, I would love to see the low of the year get traded through, whatever, in whichever seasonals NASDAQ drops, and then something good. But as of right now, technicals do not play a big role in what the market is likely to do next. This is all fundamental. All we can do now with technicals is align with this fundamental climate. Do not put too much faith in candlesticks when sentiment is driving the market. If a bullish order block fails or it gets run through multiple times, do not doubt technical analysis or do not say, get up bullish order block, get to work. No, this environment is not for that. Once everybody is happy in terms of that, investors, they've positioned themselves, technicals will now align with whatever is going to be happening next. But for now, stick to the narrative that started the year. This economic climate will be underlyingly bullish. As of right now, this order block, they're kings. This December 16th, this November 15th. These are the kings of this consolidation. These are the range, market shopping between them, premium to discount. If that's what it takes, then we don't care. We will just align ourselves with that. So if you don't have a chart separate for higher time frame analysis, you're doing it wrong. Now that that's out of the way, let's jump into a lower time frame and look at how the week printed, basically. So we started off the week without this FEG here because we had this huge gap. Analysis paralysis comes when you have too many things on your charts. We know this. I should sometimes label these lines so I remember what they're for, because I don't remember what that line is for right now. I don't remember what any of this is for. I just know what this means. Analysis paralysis comes when you have too many things in your decision-making process. This is irrelevant to me unless we can get above this. While we're inside here, the only focus is that drop was a majestic gap down. The drawn liquidity is above here. What are the bullish signatures that prints inside this? In hindsight, you could look back and appreciate range equilibrium, first FEG, aka IFEG. First FEG going down, close back through. BPR logic is fine, but if you're a stickler for ICT definitions, IFEG. Beautiful respect of the IFEG, and then all the way up. EO, this candle open, was close above. All of this is a new range. Pretty sure you could walk through all of that on your own. EO, range be made efficient. Market trading through, grabbing the high, finding support around equilibrium at the range. Market printing lows at equilibrium of the EO range, just eyeballing EQ. Big order block right at EQ. All of that good stuff, pumping higher. This is now where you look on an H1 basis to determine what do I want the technicals to agree with. So first thing, this guy. Thursday 10 a.m. is your you're lining the sand for bullishness. If it's trying to wreck 50% of this, because this is a huge candle, be open to the idea that they want to run Tuesday, 12 p.m. low again. Don't care about these wicks. I care about running back to Tuesday, 12 p.m.'s open price and then low, with the open price more than anything else. If 50% of this candle can't hold, this is what we're reaching for. Full stop.
Kesh, do you have me close below 50% already?
I have no idea. I'm just reading it. I don't know what it
Okay, okay.
I'm just reading it first, and then we put annotations on and then make sense of it. So if it closes below 50% of this, the open price right here. No, lies. Right here is what you're going to be looking for. So we could start, this is an order block. I can start getting rid of that line. All of these are the annotations. I'll probably do that on my own time to not stretch the call out too much. This FEG right here, I'm going to pull that out. There. So that FEG plus here, we're looking at this range. So I'm going to go back to here and find the lowest low. If I'm incorporating a stop run, this, if you're incorporating the stop run and the market going back to this low, this is how you frame your range from the start of the range to the lowest low. I'm not
real quick. Why aren't you using the 11 a.m. candle instead of, and you're using the 12 instead?
This one here?
Yeah, so that wouldn't that have closed over the high that was just that was put in before it?
I'm gonna show you. So let's get rid of this line since I don't know what it's for. And let us tag that right. Oh, sorry. Old age. Right there. This FEG has a meaning.
Okay.
Closing above that FEG gives us our direction.
And so we
When
can
we do
treat
your
that as an
trade,
EO when it closes that?
indeed. That means
Gotcha.
the loop has been filled.
Heard.
There we go. So if
Thank you.
I don't know where's the thing, the middle thing. There we go. Closed above here, start of a new delivery. Good. So because I'm not factoring all of this willingness to get back below the FEG, right? Make sure you understand that. Because this FEG is what frames direction. These extraneous wicks below here means nothing to me. My focus is from the open price of this candle to that high. This is now the range I'm interested in. So I'm going to take this off to not make the chart look too crowded, but I want you to understand what it means. That open price to that high, that's the range we're going to be looking at. The order block is going to be this guy. So I'm going to bodies.
Kesh, isn't this range efficient?
This one?
This.
Yeah, the range is efficient.
Mm-hmm. Okay.
So
Can I throw out another question as well quickly, please?
yeah, what about the efficient range?
About the efficient range, it wasn't about that. It was about just before that.
Okay.
Just clarifying, how come you use that FPG and not the one before it, considering the one before it is the first FPG in the leg?
This low?
No.
Wait. No, I want to show you something.
Yeah.
This low sets the precedence for which FPG you're going to pay attention to. Okay?
Okay.
I'll show you. Don't worry, I got you.
Thank you.
So going forward, encourage me to label the lines so that you don't get lost. The market expanded through here.
Mm-hmm.
For my peace of mind, expansions on the downside are going to be consecutive down candles closing below the previous candle's low.
Mm-hmm.
Market's expanding right here, right?
Yeah.
It stops right there.
Yep.
This expansion did not sweep the sell side liquidity.
Nope. Yeah.
This is an expansion.
Yep.
First FEG in the expansion is our ...
But isn't it the one before that though? That's what I was asking, even though it's very small. Or is it because of where the one before that is, you're not really counting it? Yeah, because there's one in there.
I did not see that one. Honestly, did not see what I want. This is the first one I saw.
So
Still gonna use
which
this
one? I knew he was gonna say that. Why?
Still gonna use this one. This one
Feels right.
already gone down in the history books. My God. Yeah, this is... What's the low on this candle? 379 and the high. Yeah, there is this one. So this is by definition the breakaway gap. I did not see that. This is the one I use. If we're going to be a stickler for
Precision.
which I'm fine with. Then this is the one that we're going to use, which changes this to the EO, which changes this to the open price. So I'm going to do this just for the sake of making sure that your understanding stays the way it should be.
Rules are rules.
Rules are rules. This is our FEG.
Yeah, I only asked because of the last call, to be honest. I like the one.
No worries. No worries. I do a lot of these things on the cuff. So missing something like that, I don't mind. That's our FEG. This is our close above. So your EO is the open price of the next candle right after that. Cool?
Yeah.
Since we have that FEG, I'm going to move this up to the FEG so that I can use the blue lines for...
How'd it go now, Tank? So when I come back, make sure you got your teeth brushed, okay?
Let me mute. There we go. Now move that line to the open price of this guy. That is the start of the delivery. Rules are rules. This kind of makes sense now, right? Stickler for precision.
Yeah, it does.
For precision purposes, now this makes sense. Also, you see how too much precision, isn't always needed, because while this is fun to see in terms of understanding, it's not going to change what we're looking for. Because now we have our range right there. And the range high right there. Still the range. This is still the order block. This is the order block from the day after FOMC. Remember when we swept all of that? Somebody's going to ask. This is the first one. Yeah. If you're looking for a key level, this is your key level. I'm not saying this is your key level. This is your key level. But this has to be the order block. Why? Right after the news release, look, the news release was like 2 p.m., 2:30. Look at track this delivery with me. The news data comes out. Market is going higher. In an underlyingly bullish market, the delivery will include a couple runs on sell side liquidity. So how can this bullish sentiment start going higher and we haven't taken in liquidity? So this is the morning when I said, don't force the longs. Wait for a new daily low to get taken, because these guys have to accumulate. They have to accumulate. If they don't accumulate, then Technical analysis as we know it is wrong, and we shouldn't be doing any of this. They did. New daily low was run. The sell side liquidity was inside here because this was the low of the day at the time we made the post. Running that makes this the order block. If we're going to be a stickler for precision, which I'm fine with, this down candle will frame your key level. Once it starts to get above this candle's high, it means the environment is bullish. That's what key levels do. Key levels either print the structure you want to trade or help you to frame the direction. Trade above this, I'm looking for longs. Retracement, identify sell side in here. You're going to go long here. Not very different from sell side is here on the narrative purposes. When they run that, we go long. Versus, one more time, this is my key level. When it trades above here, the environment is bullish. If I'm bullish at 8 p.m., I want to buy below a low. Where are the lows at 8 p.m. if you look left? 7 p.m., 6 p.m., start of the day. Not this, because this already ran this level. Rejection block if you are interested in every single PDRA. No problem. Rejection block. Rejection block, liquidity above the rejection block, sweep it. That's classic technical market structure shift understanding. Sprinkle fundamentals on that now, and we get bullish environment. They need to run liquidity to accumulate it. Beautiful. This must be my order block. Started delivery, key level, sell side, order block, zone, support zone. 50% of this guy has to be important. So I'm trying to figure out how to put this range plus this order block 50% on to not make the chart messy. So on your chart, whatever works for you, you can. But for the sake of not making this chart messy, I'm gonna put the GAN box with its 50% on the order block. There, trying to be precise. And then for illustration purposes, I may not keep this box on going forward. It's on you to do that. Whatever you want on your charts. It's too much colors. That is the range. Now we have key level. What can I take off from here? No idea what the red line is for. No idea what that red line is for. If I keep them on, I'm going to get analysis paralysis. I don't need them. I don't even need this because we're above all of that. Okay? So, for all intents and purposes, this is as much data that we need to look at to make a decision. We're either going to see 50% of this order block here behave #more and it didn't close below. Maybe they did on futures.
Let me check.
I figured that's why you said it. Order block 50%. This is where I make my decision. The expansion has stopped right at the key level and order block 50%. I believe we should get a gap at the market. I just don't know if this news is going to continue, but I don't need to know it. I don't need to know where they're going to open. I just need to know that once it opens, this is where it is, and then based on where it is, I can frame the range and the key levels, and we'll be fine.
Kish, do we put any importance on the open of this candle here? Since that the candle before it closed above 50% of the OB, would that be our key another key level for us to look at? Or no? Am I getting that wrong?
I'm wondering if you're asking me or telling me. What's the rule? If we have a big down candle and we close above 50%, is the key level?
Yeah, you didn't mention it, so I was just wondering if that was something that.
No, I just didn't. We didn't get into the micro details yet.
Okay.
Off the cuff. No, it's fine. I appreciate questions like that because it says that you're looking for the things that you understand. Off the cuff, we just looked at this, framed what should be important. These are just the details around that logic.
Okay.
That's what this is. Beautiful, beautiful. That would be your key level hit. At this point, when the key level gets hit, now you will allow for something bullish. And the first thing is would be a CSD. So at 2 p.m., if you're looking at H1 only, you want to see a H1 high get traded through. We don't have that yet.
Okay.
Order block high, H1 high. Everything here is pointing to a bam, bam, bam type of setup. So if this is bullish, this is my expectation. H1 classic. This has everything that you need. Range low, order block at range low, retracement to order block. If this is bullish, this is what confirms that you should start going long. Getting back above either the order block or this one for early entries. So from an H1 perspective,
And sorry, Kish, just because would this be our barricade? Because it was the last one that expanded below, correct?
correct.
Okay.
But in real time, reading left to right, here, longs would be inside here under the barricade logic.
Right.
Security guard logic and all that good stuff. So
And then as we come down, we have another setup for a barricade where we are currently.
indeed.
Okay.
So yeah, this was that day that, oh, this was yesterday, sorry. This was the long that we took yesterday. Bam. ONS low, beautiful stuff. So
Don't
it
fall,
would
baby.
be nice to go through some M5s, but I have to allow you to do some work on your own. So yeah, you have H1 logic going into the M5 now with this in mind. Your range highs, your range lows. I would suggest going through the M5, just look at how it printed, especially inside here. What confluence did these key levels offer? Time of day, all of that, to help point to that logic. Because now it's hindsight, so you can see whatever. This is now your expansion lower, which means any type of failure to get above this means we're retracing and not expanding again. If it retraces inside here and starts to go lower, that's perfectly fine because this is your first retracement objective. If you see any type of unwillingness to get above here, then logically it can't get here if it can't get above here. So now you have areas to watch. Nice and easy. We'll see next week. Oh, I said I was going to go to the M5. All right, cool. So as far as the review goes, some persons like to put on a whole lot of stuff, weekly open, not necessary. This is enough of a logic to understand what's going on. If we're bullish, that's going to hold. If not, this range becomes more important. Since this range was sell side, buy side, it's efficient. What's relevant is going to be equilibrium of the efficient range. So get rid of a little bit of these things in here and add one more thing to the chart for you. When we left equilibrium, there's your FEG. If this is breaking here, I'm open to the idea that this range low is going to get taken. That's all. We don't need anything else. We're expecting them to stay here. The open is a mystery. You can do whatever. If it's showing willingness to stay below here, I'm open to this idea. Anything else?
Do you want to label that, Kish, so you don't forget later?
Indeed. If this, then much lower. Yes, simple. Thank you. So no. Let's just go ahead and save this. Because I might forget. All right. So the review done. Now that the review is done, I'll check the chat, see if there are any questions that require my attention. Bam, bam. All right. Nothing that requires an immediate response. Just lots of good morning. Any questions from anyone?
Yes, I have a question, Kish.
Sure.
Anyway, thank you very much. Kish, I joined you in 2023, May to be precise. And after watching Trader Blueprint, I've been able to make past challenges, not one, I think more than 10. I've made a couple of withdrawals. But anytime I try to go into the new concept you bring in, I begin to crumble, I suffer. I started with the ONS. The ONS even pushed me into joining you. The ONS has helped me watching that one, MSS, then the balance price range, then draw on liquidity, the free one. That one alone was enough for me to make withdrawals. What I suffer most with is key level, how price reacts to key level. Anytime I switch to the 1 minute time frame, I struggle a lot, and sometimes I get confused. Whenever you post a chart saying the market is this way, I become confused. I forget about my analysis, follow you, then I end up realizing that you are a scalper. I am an intraday trader. Sometimes I like to hold trades for more than 1 hour or two. And it has been a whole hell for me. I make withdrawals, payouts, but at the end of the day, I give it back again. I don't know. What advice will you give me regarding this struggle?
Okay, so thank you for sharing that question. There comes a point in your development, in everybody's development, where the opinions of others start meaning less. You get to that point not out of ignorance or arrogance or ego, but when you realize that I have what I need. Almost every trader that's been with me that we don't speak or have convos for months, once they reach out, so let's say you started in 2023 and then I don't hear from you for 5-6 months, and then in 2024 2025 I get a message from you. Once we check in and say what's going on, I always say the same thing. When I don't hear from you, I assume you found profitability and you went off in peace and quiet and comfort. Okay? The reason I say that is I'm an ICT trader. I'm a proud ICT trader. I did mentorship and everything like most persons, right? But I don't entertain ICT's new lectures or whatever they are, like executions or whatever. I don't watch those under the premise that, oh wow, I need to put that in. Do you see me marking new day opening gaps? No. I don't switch to the future start and show you real time. No. It's not that I don't think those work, because that would be ungrateful to my mentor. It's just that I realize that what I need to make money is an understanding of how these markets print. I don't need your model. I don't need ICT's model. I don't need anybody's model on Twitter that's working for them. I need to understand myself, what I'm looking for, because when I sit down with these charts, ICT is not saying, hey, not that FEG, not that order block. So I need to know what works for me. A lot of times, persons will feel like when you frame a trade idea, stop loss and take profit, one of them has to get hit for you to make money. I am not of that belief. My direction just have to be correct for me to make money. And that's one of the reasons for the daily 20s. In many of the daily 20s, you see me hold exactly to the blue lines I draw. The blue lines are usually my target, and the red arrows are usually where I don't want the market to go beyond, or if it breaks those red arrows, it's just over, it's gone. In some of the daily 20s, you see me frame the blue line, and then I exit after 20 points in that direction. You have to sit with yourself and realize, okay, based on where I live, based on my financial situation, this is what I need from the markets to be comfortable. Break that down into a digestible version for yourself. I like 50 points. I like 50 points in one big trade. Experience has taught me that sometimes the market's only offering you 30. How can I get 30? How can I get 50 from a 30-point range? I add 2 positions. So you have to find that spot, and it sounds like you've already found ONS is for you. So unless there is something specific about your ONS model you want to refine, key levels, entries, or whatever, don't entertain this. Don't entertain me. And I say that like with all the love in the world. I don't entertain ICT, and I love ICT. You know, wish him all the best, all the successes, everything. But I'm not going to go through all of that. Many years of backtesting a new idea. I'm not doing that. I'll watch and appreciate if he posts an execution video. You know, if somebody says, hey, ICT, like somebody said, ICT is talking about Gandalf stuff. I'm like, what? And I went and I watched the video. Outside of that, it's no, you need what works for you. If your key level is what you're struggling with, stick to your model, improve how you find key levels around your model. That's it. Don't deviate. But lovely question. Anybody else?
Thank you very much.
Pleasure. Why not 3-bar swing low? Because I'm not. Why not the 3-bar swing low below the EO low? Because I'm focused on the open. We ran down here too many times. We have an order block already. I don't need to frame the low of the range around the first 3-bar low, which would be here, for example. Maybe because the overlapping confluence is here, you're wondering, like, why not that one? There's nothing. I don't want confusion. I want things that I'm going to execute on. I'm not going to execute on that key level for no reason. So that's just me. But if how you implement these things differ from me, but you get the same results, no problem. Don't need to change. You're not doing anything wrong. Rules apply everywhere. How do you choose which swing low to focus the important expansion on? It depends on what you want from the expansion. If you're thinking that this expansion is reaching for sell-side liquidity, then the swing low is going to be obvious when you're finding a liquidity pool, because you're looking for like a failure swing or a daily low, sell-side liquidity oriented. Once you can find the sell-side liquidity, then you can say the expansion towards that sell-side liquidity, where's the first FEG, and that makes it easier. If you're looking for swing lows in the sense that if we get beyond this low, then this is what it means for direction, etc., then you start looking at range highs, range lows, EO, all that good stuff. How do you implement logical exits and entries in ATH environments? FVGs and expansions. If you're in an environment where the market is like bullish and we're all the way above a high, nobody really wants to buy when it's above the highs. You know, buying on strength is not something that we practice, even though it's a very solid concept. The reason you get fearful of buying in all-time high environments is you don't anticipate retracements. Most times when a high gets traded through, and you're thinking buying strength, you're thinking entry fractal at the high and I buy. Entry fractal prints, and then it curses you and like, huh, this is bullish. And then you wait a little bit and then the market runs. Retracements have to be a part of your execution because they happen. Like retracements happen. In the daily 20 video yesterday, I did an arrow to frame that I'm expecting that retracement. And then you saw it drop and it pulled back. You know, I had opportunities to enter a second time, but that wasn't the point of the call. And because it was paper, to not like I'm going to make any money from that, from entering a second time. So I didn't do anything there. But I showed that, hey, in this delivery, this is what I'm looking for. The drop below the low with FEG, if you look again, then it pumps back up and then go lower. I framed where 20 points was because it's a 20-point scalp video. And then the draw on liquidity when it's low, I made that clear as well. So everything there was good. So I don't know if this is something I can try to explain better right now, but the advice is, or the response that you're looking for is, you need to better understand when the markets are likely to retrace and when no retracements are needed. And that will give you confidence to sell lows and buy highs or wherever your entry is going to be. If the retracement has not happened yet and an entry fractal is printing, expect the entry fractal to fail. Let me show you something. I think it's bam, bam, bam. Classic pattern where there's a range inside here and a breakout and retracement to an expansion or retracement to an order block and then execution lower. This is a classic pattern. Most people think that this is always going to happen and it's going to be one smooth drop, one smooth rally, then another drop for ABC. Right? ABC is a pattern, is a thing. If you're old enough to know that, that's a thing. So when things like this happen, persons don't know what to do with this. So when this happens, you get crushed. But this is the same thing. It's a logic, not a pattern. And this is the delivery of that logic. Or it's a process that prints, and these are how it prints. It could happen in Elliott wave. I haven't seen that in a while. What happened to the Elliott wave, guys? What happened to the... I don't see any schematic charts anymore. Remember when you used to whack off schematics? You used to see a whole lot of those.
Change their
Oh
name.
my days.
When
Why?
WWE was a thing. Man, you guys missed all of the good stuff.
What? For 100 to 1 trades?
So you were alive. Yeah. See, you know
Yeah. Nearly died from it, but yeah, I was alive.
If you think that's funny, what happened to the ICT daily profile, guys?
Oh,
I
crap.
haven't seen that classic buy day, a London reversal, whatever. I haven't seen those in a while. What happened? What happened to those guys, man? When was the last time you saw Osok on somebody's chart? Here's the week we got one kill.
No, let me not die. I see Allsop every week because of Everett. Everett is a still one player.
Okay, fair enough.
We still alive, Kish. We still alive. We here.
So just saying. If you've been alive long enough to see like, rise and fall of like CLS, what happened to the CLS guys? These guys that were telling you that this was a thing.
Recording in progress.
The only other person I know that talks about 90-minute cycles with any degree of success is Zusi.
Mm-hmm.
He's the only person I know to this date that shows any type of consistency with 90-minute cycles. I was tempted to teach 90-minute cycles, but let me just... Why?
Yeah.
Show you the stark difference between what people think it is and what I think it is. Just for fun. That's for fun.
Sounds like a good challenge to take then, huh?
Yeah.
But
So you're gonna teach Gartley patterns instead, or what?
what in the name of
Back to God, yo.
cup and shoulder and all that inverse cup, head and shoulder? We've seen them all.
Butterfly.
We've seen them all, man. Ah,
He likes the Wendy's pattern, I heard.
Low blow.
But yeah, so you guys understand what I mean, right?
Fries.
These things used to be everywhere, but now, I don't know what happened. Everybody just, but yeah. So to go back to what this means to me, everything is a process. Since the very first time I started doing this, one of the first models I've ever taught, I taught it to one of the first 10 persons who came into the quote unquote private mentorship when I started. And because the call was done, because the model was taught on a Zoom call, the guys in the group were horrible at naming stuff, named it the Zoom model. First model I taught. And it was a process. And every one of those calls I said the same thing. Stop thinking this is a pattern. This is not a pattern. This is an understanding. Understand what is happening in this fractal, and you will find setups. You remember Fire Your Boss, right? Lots of stuff. I mean, I've taught so many models over the years, but for those who might not know, the Zoom model is a fractal that led to my understanding of what an order block should do. Because like every other ICT trader, I struggled with finding the right order block. And everybody who used to post executions at order block kept telling me the same thing. An order block is better than FEG. Well, okay. Down candle, up move, FEG, cooked. Something is going on here. I must be doing something wrong. So I spent a whole lot of time doing that. And I did the most logical thing. Maybe he was trying to teach me something, and because I was just rushing to trade live, I missed it. So rewatch the videos. Rewatch the video. Elements to a trade setup month 1 to 4. I've watched those videos a lot of times. And I encourage everybody. Month 5 and afterwards is for the degree in trading. But month 1 to 4 is what you need to actually execute. And then probably month 10 for the guys who trade futures a lot. But yeah. The Zoom model is an understanding that says markets print like this if an algorithm is present. 1 second. Let me. Oh, okay. Markets print like this, right? If there is an actual algorithm in the market running all of this, I understand a little bit of coding. It must have reference point. How is it going to run a high when it does not know what the high is? So it has to create the high, create the low because it must be a range. Then after the range is done, it will reach for the low, reach for the high, reach inside it, something. If you know where the range is, that's the whole point of me putting on stuff like this and pointing the ranges. If you know where the range is, you can trust what should print in line with whatever the narrative is. Ranges is not narrative. Range is just a high and the low. The narrative shows you that we're reaching for the high of the range or the low of the range. So I came to the understanding that if this is the range and liquidity is above it and below it, wouldn't they accumulate here and distribute there, or accumulate there and distribute there? But the accumulation is pairing orders. And if you pair an order in trading terms, you get an order block. If you pair an order in financial terms, you get an order book. And the book is going to include where you get in and where you get out. So once the range is finished, the book is built. The book says, by here, sell at that price. Book doesn't include time, it's just prices. Orders, execution, that's it. So that's telling me that once I have the range, order block is going to print there. Markets retrace because it's one of the 4 environments. And then we offset like that. If the book includes a low that's beyond here, then let me put this here for somebody to appreciate. Let's go all the way down here. Let's go here. Let's go here. If we have the book being built here and liquidity was to the left of that range, we might get this. And we might get something like this, which is essentially showing you how the book reaches above here to sell. So there may be buy orders that are offset here, then a sell orders accumulated and then distributed below obvious pools of liquidity as it trades. This understanding translates to everything and every time frame, even bar by bar analysis. In between these spaces are where you can expect inefficiencies to print, expect FVGs to print. So that's telling you, if you see something like this, all right, let's say a big FEG is right there. And this here, in this fractal, is an element housing liquidity. It could mean we go through the FEG, liquidity above the FEG, whatever it needs to do down there. Perfect head and shoulder. In order for you to appreciate the turning points here, you have to see what's going on. Why do I pick that low? Because it's a low housing liquidity. If it's a stop run, I'm not looking at it. If there's a big FEG here, the first low after the big gap, watch that low. If you're looking at candle by candle, same thing. FEG, big drop. If it's going to retrace, it's going to do it after it takes that candle high. Why not right here? Because when this candle is printing, it can't reference itself like that. It's after, then that gets referenced. You know, it's how coding works. It's a step and a function, then a step and a function, then a step and a function. Step, function. Function is get here. When it gets here, retrace. And you should be able to identify where it should retrace to. So if it gets here and it does not retrace, what do? Wait. This is almost like a flip of this, now that I look at it. Where this would be that high, and then this drop is that, and then blah, 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 yeah. So this is an example of how this can print. It's the same thing. These are the things that help you to understand retracement and then dealing ranges. Buy side run, sell side run, retrace, and expand. So this all nests together to make your understanding better. So it doesn't matter what the candles look like. What if the FEG doesn't print there? What if the FEG prints all the way down here? And then all of this is efficient. Do I still look for this? Probably not. What can happen instead? That where the market retraces to an FEG that's up here instead of this one that's absent, and you have buy side, retrace, sell side, and expand. Those are the things that you have to see, but you have to know that the processes print around these things. So this is where I expect it. So you're in a short, that high should remain. It's pulling back. Okay, where is it pulling back to? That's how you start looking. You run that liquidity here. Is there FEGs in that leg? Did we close the FEGs with 1? BPRs, all of that. So if this was an expansion higher, and then this is your breakaway gap right there, and the market reaches down into the breakaway gap, and you know that the narrative is bearish, expect it to pull back. You want it to crush here and then run, but expect them to show some amount of, you know, this level used to be a thing, so now we're just being a little bit sensitive around that level. That's all. It's like a traumatic event that caused you pain before, caused you a little bit more pain. You get stronger, then you get beyond it. So you can start anticipating that these are the areas that it should retrace from, and that's how you come up with things like this. When you look at the charts, like, okay, cool. These candles are saying a lot of things, and I don't care. What am I going to do to make a decision? I don't know. But what can I make decision around? Okay, I know if it looks like this, this is what we're likely to get. If it looks like this is what I'm going to do. And then you start marking those things. And that's why we can say for next week, I don't need what is left of this candle here. I don't need what's left of that. If it opens and it's already below it, then we incorporate. No analysis paralysis there when you only mark the things that, you know, get out of your head. So that's that. Now, putting this together, listen to this call is going to take more than re-watching the call. It's going to take practice. The BPR logic and the FEG stuff should, at this point, you should be flirting with the idea now. It's not, you're not strangers on a bus anymore. You've been introduced and you're seeing them when you go jogging and when you go for a walk. So you could say hi. Now you can start flirting because that first wall has been broken. Now you want to get intimate with the FEG. When does the FEG highlight efficiency? This is what a lot of persons struggle with. So, first thing we're going to look at today is the concept of efficiency. Efficiency is always derived from the delivery present. What it means is every delivery has the same functions. A range is created. No drawing. Can't find a drawing. Okay, never mind. Range is created, then a look back function is initiated right when the range is done. The look back function is checking for, since the start of the range, do we have efficiency? Most times we misinterpret what that means because we're just not looking, or we don't know the time the expansion, the delivery starts. Overnight session is where it's your one-stop shop for looking at efficiency. You go to 4 a.m., you look at, since 4 a.m., what's the market been doing? If it's been doing this, you're looking for, okay, do we have overlapping wicks? Meaning this. Does the wick of the previous one go below that? Not an FEG. You know what an FEG is, so you should know what overlapping wicks are. Cool. You're looking for that. Wherever there's no overlapping wicks, you could start by marking the FEG. So there's an FEG, there's an FEG, there's an FEG. Okay, cool. I have a couple FEGs. Which ones are important? Well, rule says first and the second, everything else is irrelevant. Okay, I identified 10 FEGs in the expansion leg. Gotta go. Now I'm left with 2. Okay, since these 2 FEGs are framing efficiency, did we fill them? Yes, find 50% of the range high to low. No, keep the FEGs on for inefficiencies. Game over. Left to right, you never have to overthink. Since the start, Did it create a first FEG? Yes or no? That's a decision tree. Did it create a first FEG since the start of delivery? Yes or no? If it yes, is the FEG filled? Yes. Find 50%. Yes. Did we retrace? Yes. You understand what I'm saying? Then you can start seeing what you should do next. So you never wonder, is this going to work? Or, well, I wanted to buy, but it's going so close to the low. I don't know what I should do. Maybe I should go for a sell. It removes that type of thinking because now you have a process that says this is what you should do. This is the conditions under which you should do it and nothing else. That will point to when 50% of your range should be more important than whatever else is there. If an FEG is there, unfilled, first FEG, always find them. It might take some time to get comfortable seeing it, but once you start slapping on overnight session on, it should be easier. Should be. Just look at the video yesterday. The video yesterday shows you how, put up the chart, saw the FEG, shorted it, highlighted it so you could see, and then just what's the rest? Because I'm conditioned to look for that process. Like that's how I think. I don't think like, all right, naked chart, high, low, bam, but I can't think like that. Or maybe I could, but I just don't think like that. I think, what is it doing and what does it mean? Well, it's trading through highs. Okay, that means that EO is somewhere here. So let me find the high, find the EO. Okay, cool. Since it's EO, what's the delivery like since the start of EO? It's been one-sided. Okay, this is an inefficiency. Did they come back and fill it? Yep, okay. Now, if it's filled the inefficiency, it should be trying to leave that range. Find the high of the range since EO, find the low of the range since EO. Okay, where's 50%? What is it trying to do at 50%? It's creating an order block. Okay, I'm bullish. If I'm bullish, I'm going to buy this. It prints, execute. Simple. Like that's it. That right there is exactly how you need to frame any time frame. Any time frame, any charts. Just walk through it like that. You're good. Efficiency will start with time. Time theory is everybody's Achilles heel. But you don't need time theory for efficiency. You literally can frame delivery starts, origin starts, and still find time deliveries without knowing that it's a time delivery. What do I mean? Okay. This is an hourly chart. Time theory on an hourly chart takes you into the depth of madness. You don't want that. I don't even want that. So, what's the market like since the start of this? Right? Let's do this. Been a while since I did this. Started delivery, open price of 1 p.m. Any FEGs there? Nope. Okay. We had up candles, then down candles. Did the down candles close beyond this candle's open price? Yes or no? If yes, that is efficient. You could fib here to here and start reading it in real time, whatever time frame. It didn't close, then there's a tiny inefficiency there, kind of like this. See how I missed this because we framed it around that? The logic still worked because the rules keep us in check. Precision takes us here. Delivery starts, no down candles close below this open price. Just to check for this conversation, the open price is 21,415.3. The closing price on this is 21,409. So it's above 415. Eyeballing, right? No discrepancy. This did it. So in real time, range high, range low, not swing low. This is swing high, not swing low. So you automatically know run that low. Here's the plan. Let me try a different. No.
Yo, yeah. No, hear you clear now.
Huh?
Not hearing you. Some distortion.
Uh,
Better now, better now. Yo.
1 second.
Yeah.
Can you hear me now?
Yeah, 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 yeah.
Okay. Lost my chain of thought. Inefficiencies. So let's pick a chart without annotations on. Okay. We have this. We know a pool of sell side liquidity was run down here. On NASDAQ, it was all the way down here. Okay. Everybody with me so far?
Yes.
Yes, yes.
Yes, yes.
Sell side liquidity. This expansion did not take sell side. This expansion did not take sell side here. See that? Because it failed. This is the expansion through the liquidity pool. Ergo, classic FEG. Classic FEG because it's the FEG that's going to the liquidity pool. Everything I want is going to be framed around this. So now how do I use this portion? Easy. That becomes a range. The last expansion. Specifically there, because that's the last time we closed below. So now I know this is a range. This is a run below the range. How can I trade that? Mark my range low. Now I start asking questions. Since the start of the delivery, okay, let me get that green line off. Okay. Since the start of the delivery, are there FEGs in the delivery? The low on this candle is 43.9. The high on this candle is 43.1. So there's a tiny FEG right there. This is because I'm being a stickler for precision, for the sake of rules and encouraging good behavior. Yeah. When you get to the point where you want to break your rules, go ahead. But for right now, just learn them the right way. This is your draw on liquidity inside here. All of this is inefficient until we get here with a green candle body. When a green candle body comes into play here, 50% of that becomes beautiful. So put 50% of there to there on. But why there? It's not the start of the delivery. Because above here is inefficient. This is the start of the delivery. All of this is inefficient. You can't target that until this is filled. So there's your delivery. For prognostication, this is for the persons who have developed the confidence to trust narrative before candles print. Let me say that again. There are different levels of traders on the call. There are persons who are brand new. There are persons who are seasoned. There are persons who are finding their way. There are persons who still don't know why we keep coming here because they don't know what we're talking about. We understand that. The guys who have gotten to a level of confidence with this will understand how framing the narrative and where the key levels will print will show you setups way before the candles print. Like we know once it starts to close above here, it's going to put something there. What is it going to be? I don't know, but something is going to be there. And the best part about it, it will be something you can recognize. That's it. So if you look at this now and you're like, but I don't recognize anything. Okay. We have consecutive down close candles. Did this guy close above this open? Closing price is 612. Open price is 612. Did it? No, it did not. Where's my key level? Right there. Wow. 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 Nothing was like just rules. Once the green candle gets above here, this range is finished. So why didn't trade above here? And you said that the 50% is going to be important and it didn't come back here. Like I would have put a limit there and waited for it, and then I wouldn't have gotten a trade, and then you guys would have been posting setups. What's the order of delivery here? If we want to see an expansion through here, and we're thinking classic dealing range logic, sell side, buy side, retrace and expand, and the buy side is here. This is the sell side. We went above equilibrium. We went below equilibrium. We went above equilibrium. We went below equilibrium. Sell side, retracement. What do you expect here? Buy side and expand. Buy side and expand. Ignore this. Ignore this. Don't look at this yet. When this is done, all of the range is now efficient. So what do I do? Now I have my key level. If this is going to reach inside here, focus on the expansion to here. Are there FEGs inside this expansion? No. So if we know that this expansion portion houses FEGs that we could target for retracement, and there is none, it has to be the lows before that high was formed. But we don't look at just any lows. So trying to be as precise as possible. The high on this candle is 71.9. The high on this candle is 72. Where are my failure swings before this? Here. If this market starts to drop, where would it likely retrace before continuing lower? Or put an order block and then pump higher? Right there. So at this point in time, I'm interested in this. This chart isn't offering much FEGs, but you have your drawn liquidity. Drop to a lower time frame and frame whatever FEGs you need to find to get to your key level. I'm an M5 kind of guy. Let's go to Tuesday. There we go. This here is a drawn liquidity. So before I get confused, let's just tag it as DOL. That's your drawn liquidity. I think the market's going to hit that and then retrace. Tuesday, it happened on Wednesday. So let's look at it on Wednesday like we were trading it. First thing you're going to do is find 4 a.m. on Wednesday. But Kish, this run is high again. We're not trading inside here. Leave it alone. Once you find 4 a.m., then you find 8 a.m. Here. Beautiful. Now that we have our overnight session range, we know the drawn liquidity. The only thing we're focused on now is the execution for a trade. I need my low. So from here, the low before 8 o'clock is right here at 7:55. There. Okay. This did not sweep overnight session low. Please, right? Let's be real here. This did not sweep overnight session low. you can't sweep the low if the range hasn't been finished. Now, there are some persons that are going to argue with my 8 o'clock start time, and I'm going to leave you to look at the market a little bit more and see what's happening so that you can understand what I'm going to say a little bit better. Where's the expansion through overnight session low? Where's my FEG? We just started trading at 8 o'clock. And we know that is your breakaway gap. So when breakaway gaps are being traded, one of the first ideas that you should think about is called IOFED, which means when this candle's high gets traded to, you want a CSD and execution. Nothing to trade, nothing to trade. Wixen rejects it, displaces. Is this displacement running below here? No. This is running below here. Is there a FEG? No. What does that tell you? It tells me that since this is the first low and this is the displacement, whenever it closes through here, there's going to be a breakaway gap. Market retraces because buy side, sell side, retrace and expand, right? Hits it and rejects it. You like it, you go short here. The drawn liquidity line is here. Cool? This is above the drawn liquidity. We retrace here. You're short here at 55 and you're out there. Right here, unless you've gotten lost in the charts, you are expecting a retracement. Where is it going to retrace to? Well, since we just made a low, ran the range low, displaced, making a new range. This is the stop run, making a new range. I have my range high and range low prior to the stop run. Grab my good friend. I am going to start stalking key levels and entries around 50%. It's it here, no displacement. Once we close below here, between this low, and this is the fun part, between this low right there and this high right there, I'm going to sell this and then get that. And I'm going to add right here because the good book says I can. And again, all that. And then I'm done right there. This is the M5 view of all of this that we've been looking at. The H1 had no FEGs. The M5 has a lot. And all of that makes sense. This, why that low? Because after it expanded here, and I got my entry here, expansions reach for liquidity. You don't expand towards an imbalance. So, in classical definition, but I'm sure you can frame an example where it expanded towards. But for understanding, you don't expand for imbalances, you expand for liquidity. And liquidity is below the ranges. So if you expand for liquidity and you reach the liquidity pools are paired with ... It's going to take you a while to get that ... but it's going to be fun when you actually do. Reversals are taking place here. What's the reversal setup look like? Well, it was dropping down and it hit that higher time frame level, a little bit beyond what we wanted, but who's complaining? Reverse. My God, look at that. Which do the damage, bodies tell the story. Classic ICT. Now, what are you reaching for when it starts to reverse here? Why that? Because everything here is under one narrative. We've left this range and we're expanding. If it's going to reach higher, it's going to get back into efficient range. But it's an efficient range. Why would you want the high? Because the narrative is bullish. But it hit here and then it fell low. Yes, it's an efficient range. In efficient ranges, this guy is king. You're long, it gets here, it fails, runs a low. But how do you find what low? You find the highs and you look left. Which one of these are untapped? All the way down to here. What? No joke. I'm not joking. I'm serious. Look. Since that, untapped, untapped, untapped. So you're telling me I could miss all of this push and get this? I'm not telling you anything. I'm just showing you. From this moment on, you want higher prices. All you're doing is key levels and entry every day. Don't let the wiggles and waggles fool you. Time refines all of that. Key levels and drawn liquidity is one thing. But if you know that this is when I should be executing, I don't care what this is doing. The most obvious mistake a lot of us make is just, it's been dropping, so give me that high. Sure. Stop out. Stop out. Oh, it's so close to my TP. I need TP to make money. Stop out. Runs to TP. Man, if I'd only. No, we don't do that anymore. This is 2025. We don't do that. What we do is we go to the market, we find key levels. I'm not going to try to justify why that's a trade or why you could. I'm going to leave that to you. You're going to look inside here on your own. What if I'm going to look at all these things you're saying, how am I going to find it? Well, so far I've taught one simple logic. One, look for expansions. I'm going to find the first FVGs in expansions, and then I'm going to frame them. But where's the last time we expanded low? When it took this low. Yes. Where's the FVG in that? There's the FVG right there. Focus on what happens there. But this one is lower. That's a retracement FVG. But the order block reversal liquidity pool is down here. So what? You're not entering the first time it touches the FVG. You're looking for a narrative or structure to print in line with what this FVG is supposed to do. So what if it comes down and it closes below that level? Then you wait for the down candle that closes below here. It's high to get taken. Where's the down candle that closes below here? This one. But why not this one? Because this is the first. We trade above it here. Would you buy this? Me? Of course. Would I buy this again? Me? Of course. Would I buy this again? Of course. Kish, nice trade, but I missed it because my key level was down here. Oh. You just pointing the down candle and hoping for them to work. Way too much faith in the church of candles, my friend. Way too much faith. Man, my limit just never got filled. Wow. Must be random. But anyway, run away with the efficiencies. That's ranges. Yes. Little bit of time theory. So that checks off everything on my list of 1, 2, 3, 4, 5 things to talk about. Whew.
This is a deep pool we're in right now.
You giving us some time to breathe now.
February, I have a little project I want to work on, and I know it's going to take some time. I haven't made PowerPoints in a while. Kind of excited for that. Got some fresh minds to enlighten. So that's going to consume a whole lot of my February. So I'm telling you no, my February is going to be on working on a project that I've been wanting to do for so long, but human nature has, kept telling me not to. And finally, I feel content enough to have a blast.
Goosebumps.
And I'm doing this one time. Like this is not a you know, every year we come and get no. This is happening one time and one time only. I'm gonna pour my heart into this, get these guys where they need to be, and from then on out, it's potentially going to be just hopping on a live call every now and then and watching the growth and development. This is not happening again. There is no signing up for more. There is no, this is it. The amount of things I'm giving you in January, if those don't show you the way, you don't want to do this. That is it. You don't want to do this. And I'm not doing this again because I've never in my 6 years of trading felt this free. Every time in the past, it's been somebody's dishonoring my trust. Somebody's trying to do this. Somebody's trying to stab me in the back. And I'm like, you realize I could have never done this in the first place. I could have never argued with anybody about what an order block should actually be. But, I'm human. So we're here now. And there's nobody in my immediate circle that I cannot trust. So this is a result of that. I feed off the energy around me. Which is why if you don't tell me that, hey, Kish, I'm struggling with this, I'll assume that you got this. And this is why I will feel your pain if you talk to me. Now feel your gratitude. I'll get goosebumps when you tell me you win. And I'll feel teary-eyed when you tell me bad stuff happened. But yeah, this is not happening again. I'm telling you that.
The final curtain call.
Yes. Slytherins.
Ish, I've got a question, if you don't mind.
Sure.
I'm the guy who sent you the document of the entry fractal. I'm pretty sure I already know the answer to this question, especially after this video, because I think you might have marked it out a couple of times without knowing. But anyway, specifically the entry fractal, when you draw it out to visualize it, is it body or wick?
That's kind of vague.
As in specifically on your smaller time frames, right? So rather than the one, once you find your narrative, your direction, your key level, when you're looking for your entry, you get your 2 up close, your 2 down close candles. When you sort of, because you're waiting for the CISD on the second, are you looking for the wick, the CISD to be completed on the wick or on the body of that candle?
So, that question is pulling at a whole lot of strings, right? A whole lot of strings. Let me just hear these lines. A whole lot of strings.
Because I had a feeling that it would be different on a 1 minute to a 5 minute.
No. Rules are rules. It's just, is it there or is it not there?
Okay.
Especially to be there is not going to help. Let's take a look at this, right? Consecutive down close candles, we stop closing below. Key level, done and dusted.
Yep.
What does this key level mean? Not a rhetorical question. What does this key level mean to you?
This key level is where I'm looking for my CISD to frame my entry to go along.
No. Well, okay. Sorry. That's there's so many things wrong. I cannot tell you that what it means for you is wrong. That's
sorry. I mean, like, there's also the
don't
security
change,
guard.
don't
There's
change,
the concept behind it is like the security guard concept, right?
Don't change. I said that for a reason.
Okay.
Because a lot of persons struggle with key levels, but they identify analysis perfectly and then trade sprint, but they don't get in. Every time you mark something on a chart should mean something. That's a difference between analysis versus marking a chart. Grabbing an FEG versus marking an FEG it must mean something. This here says my direction is higher. This has nothing to do with my entry. Was it yesterday or the day before in a call I said, when this happens, it tells you where to look. Anybody remembers? Please say yes.
I think I was on that call. Yeah, I do remember. So
yesterday.
that gives you that confidence, right, to enter below the open of that next candle.
Right. So if this, then that. There.
Okay, refinement. I see.
Anybody doesn't understand what I'm doing here? Don't be shy.
I do, but I thought it would have been. Oh no, wait, it's down. Don't
You don't know where the open price of a down candle is? No worries, no worries, no worries. Cool. So once we trade above that, that says my direction is intact. Now my entry is going to be here. Conviction. It's a 5-minute chart. So you could frame it on a 5-minute chart and then stock M1. You could frame it on a 5-minute and just leave it at M5. You could do whatever. But you have to know what you're looking for. It's not just down candles, we're going above, buy. Sure, you can do that. And in most cases, you will be fine with that. But I'm arguing that that's not what you want. That's not what you're trying to do. So make it like the rules are too easy to not get in.
I understand. Fair enough. Thank you, Kish.
All good, all good, all good. And then this just automatically tells you again that here is a low. Like I can see this. Maybe with the time on, I can see exactly what this is. This means that we have previous hourly low. Is it?
Yeah, it is.
Just looking at what this is, right? Just eyeballing. Previous hourly low. Displacement through the liquidity pool. The displacement started here. This has a definition. This has a definition. I know what this means. This is suggesting something in this narrative. The narrative of us expanding through a low. This is now saying something. This is confirming it. This is cementing it. Now, whatever prints bullish, you're good. All you have to do is find out where is the drawn liquidity. I don't know where it is on this chart, on this M5. I don't have enough data. Look, but that shouldn't be an issue. And then you go into the M1 and it probably gets a little bit nicer. I would argue, I think probably tinier. But this should be enough for you to frame whatever you want. Somebody's about to say something.
I was questioned then. The down candle that you marked, not before, not now.
This one or this one? One or two?
That one. The second one. The second one. Question. You see when it if you're expecting delivery to be a little slow, does that affect your stop loss placement, or are you looking at it? Why I ask is there are times when that can happen and then we take that low again, just sweep it. So are you accounting for that in your stop loss, or are you looking at it as if that happens then I'll just enter again?
I'll enter again. I'm trading the narrative, and the narrative is this is probably, like, arguably, this is very, very close to like perfection. Like, if you look at it and you've actually practiced this a couple of times, this is like perfection. The expansion to the liquidity, the FEG is right there. It's not a huge range. CSD clear. Here is clear. Your stop loss placement has to be clear here as well. Has to be clear. Expectation.
Hold on, just a second. I need to figure out how to turn him down because I'm still on the call.
Expectation is that it's going to trade above here, liquidity pool, breakers for the breaker fans, expand here through here. This is the expansion. This is an entry you can take because this expansion started and it comes back down, long that, and expect it to break through that. So then that's where you don't want to see bodies. That FEG has a definition, has a role to play. Everything you want is going to print right there. Big FEG, first low. That's what you want. I want to buy below that low. And that low is at 101.6. And this low is at 101.6. So relative equal lows. ICT should be beautiful right here. Beautiful long.
Are you looking at that as the first F?
I'm reading it for what it is. I'm like witchcraft.
No, I know.
It's just me.
But I just wondering.
Oh, quick question, mate.
There are.
All right, Arthur, I mute you because your audio is cutting in. You're probably not going to see it. Probably if it's an internet thing. But
yeah, I know that.
Can I ask a question, mate?
The question was, the expansion starts quite a bit lower.
Which one? This?
So you had marked there, mentioning that the first FEG, that's where you expect price to go. That's IOFED. So in this situation right here, when we close above here, because I had this happen to me also, where I had a situation here I was going to buy and target like a high up here, but seeing this, I was like, okay, I can't, because me buying this, getting to here, isn't this supposed to be when I get CSD down and maybe close below here, then that's a continuation to go lower. So why trust this in the hope of it getting above here in that case? I don't know if that makes sense.
It does. I understand the question 100%. On a couple calls before, I don't remember what we're doing, but I was framing something that when you have the hourly candle closing very close to its high, so there's no pullback off the high or pullback off the low, and then the new candle is coming out, most times you get the new candle on the H1. Let's put a line at the start of the H1. The new H1 sweeping and then reversing. So let's say you're bullish and you have this low. While there's nothing here to be bullish for, this is a run on the low. Based on where you are in your development, this is not an entry for you, and that is fine, okay? As you progress doing this for a while, looking at nothing else, you are going, assuming you journal religiously in the beginning, you are going to see these. You're going to see when the new H1 opens and runs a low, and all that the things that you want are printing right there, and then it goes. This is not an entry for everyone. It's a key level that you will identify for sure because you'll see it, and then some persons will trust it. But some persons will also see this and not want to take a trade there. 1,000,000% fine. This is something that you should see. And if you don't see this, this is something that you should see. There's no other FEGs in the expansion. And the expansion stops right here at 10 o'clock. So even if this is going to expand, and then this is going to do the same thing and run if 10 o'clock is going to run the 9 o'clock high, 9 o'clock high is all the way down here. This is not expanding through a high. It's an expansion, but it's not expanding through a high. So how can you pair this with reversal if there's no liquidity pools, and liquidities are paired with liquid and reversals are paired with liquidity pools? 11 o'clock starts here. 11 o'clock is now above 10 o'clock high. The expansion at 11 o'clock through 10 o'clock high does not have liquidity pool. See? We have up candles. See? No, yes, maybe.
Yeah,
so.
say it perfectly. Cheers. One more thing, because I've been battling with this quite a bit, is so I usually do 50K accounts, and so usually one contract on NQ, but a lot of the times, you frame a stop, it's a bit more, and with like a 2K, 2.5K drawdown, that means you literally have like a handful of trades to go in. And what would you recommend? And I know I've tried to ask quite a few people, it's like it's personal. I don't know. So is there anything you'd recommend that, okay, go this way if you want to, go that route with futures profit?
Then one of two things. You're either going to have to leave these entries alone all the way down here and wait for the confirmation ones, because those tend to be quicker. Once this is done and there's no reason to go lower, these tend to move a lot faster. So you might want to look at these. That's a little bit vague.
Or trade micros.
Or trade micros instead of one.
Yeah, trade micros.
5 micros and then add again. Or 3, 3, 2. Or
yeah.
3,
2, 2, 1.
Yeah. Build into the position. But you'll have to find those setups that are worth building in and those that you could just squeeze on. And then it should be easier.
Oh, okay. Cheers. Thank you. Appreciate it.
All good, all good, all good.
Hey, Kish, I have a question.
Mm-hmm.
So I've only been in the group now for about a week. I am on video 3 on the Trader Blueprint. Video 2, I feel even this week has helped me out a lot. Just I realized that, like you're saying, the difference between marking charts and analysis, that I used to just mark stuff on a chart. I think though my biggest issue has been trying to create a model for myself and being able to stick to it. And I'm still trying to develop into how to create a model for myself. And that's kind of what, watching you when I found you, just watching you trade, is it trying to seeing that you had rules and sticking to a model, and it wasn't just all over the place. That nothing against ICT. I've been watching ICT, but it's like he comes out with a model every few weeks, and he presents something, and then you see it. And I've never really refined one thing, and I'm trying to get to that where I'm refining one thing, and so I can perfect that. And I'm just trying to. What would be your suggestions on trying to refine a personal model and how to get there?
I like that question because while you're the one that asked it, a lot of persons are struggling with the same thing. So for simplicity, trading or successful trading has components to it, right? The first thing that comes with successful trading is understanding narrative. Narrative comes in the form of technicals and fundamentals. Fundamentals are a little bit easier because they're podcasts and they're professional traders or investors who share economic climate and economic stuff. And then there's a million free stuff there. So the fundamental part is easy. Understand that, hey, this is what these guys are doing. And then go into your chart and thinking, these are the things that happen under certain environments. So narrative, let me type this out. Narrative is the first thing you want to fully understand when creating a model. Your narrative refers to the different environments that print in the market. Are we in a consolidation narrative? Is the market's expanding, bullish, is it bearish? Those are the things that you want to get first. Once you get those things first, then you start looking for classic ICT month 1, lesson 1. Under these narratives or under these conditions, these are the things that are important. We don't go marking every FEG. We don't go marking every swing high. We mark In this environment, this is where something is supposed to happen because the market should reference this. So once you go narrative, key level, this or these alone will make you an analyst, not a trader. Most persons don't get beyond this, or most persons substitute one of these for something else. But I'll try to point out as much as I can. What are we doing? Where should I look? Confirmation, meaning if this is the environment and this is what I should be looking at, this is what needs to happen there to tell me the direction of the market. I can be bullish, and at support, we're not bullish because we haven't gotten a CSD. I can be bullish, and at support, I'm not bullish because we haven't gotten a CSD. So I'm watching a low and a big down candle prints, but we don't trade through the down candle high. We're still inside the down candle body. We're not closing about 50%. That's not an entry. You don't have a trade. Watching all of that, pointing it, label it in real time will make you an analyst. Once you can see these and understand what they mean, then you go to so your process as a trader, hope this is not killing your eyes. Your process as a trader should be around this. When we're doing calls, I start on a daily chart because I want to share with you why I believe the narrative is going to be something, or why I will stick to a narrative, why I will say I'm bullish and the market is making a low, making a lower low, making a low, and I'm still looking for longs because of the narrative. While we're watching those, I will mark levels. This is where I'm watching. This is what I want to see at that level. If that happens at the level, I will say I'm going to buy the next candle. That's the entry fractal. Once you have all of this down and you can confidently know that I'm not taking that one because it doesn't follow this. I am taking that one because this. You will start seeing variations of this and this. Maybe all three. You don't see variation of narrative. You can see variation of this. Variation of a key level, easy. 2 down close candles. 1 big one through it. Key level is easy. Okay, 2 down close candles, not 1 big up candle, but smaller up candles. That's a variation of your key level. What's the confirmation based on the key level? The confirmation based on the key level gives you your entry fractal. If your model / process, because it really should be a process. Model is just a fancy word that's been passed around forever, and we just accept it. For me, it's a process. If this is the process that is printing, and these are the levels I should give importance to, what's printing at those levels? Backtest. Once you get that definition, backtest. Over a sample size of whatever amount of time, whatever number of pairs, whatever time frame, I keep seeing this one. I see this one more. I see a combination of them. Look at the delivery from all of this to your drawn liquidity in each of those environments, or based on the key level and the variations of the key level and the confirmation. And that would give you what's an A+ setup versus not an A+ setup. And that's how you frame risk. I've seen this process before, like dealing range logic. Okay. By now, you should start understanding buy side, sell side, retrace and expand. You're selling into the retracement. Unless you had the key level for the run on buy side liquidity. For example, let's say that is a key level, and this is another key level, and I'm looking for the market to trade higher. Okay, let's say this is H1 derived, because I like H1. I pick most of my levels from the H1 when I'm thinking big moves. Let's say it's H1 derived. So I have my narrative, bullish order flow, key level, here, confirmation. What am I going to be doing? What am I going to be doing is based on when I get to the chart, where are we in this expectation? If we're down here, then that's easy. I'm looking for a bullish setup. What if we're here? I'm looking for what happens at that key level. Most times, like a lot of time, like an insane amount of time, this is happening at your key level. All you have to do is identify what that range is. Sometimes it's overnight session, sometimes it's an hourly high, sometimes it's a daily high. You know, something. Zoom, for one, loves to print like this because they understand the strategies that person's trade. Let's say you mark a daily low down here. You're looking to go long at that low. The market drops and it starts to pull back aggressively. You want to buy here. Put in your stop here and here. Tic-tac-toe.
And again, I'm new. So I really haven't seen the Zoom model yet.
Oh no, that's fine.
No, I was just gonna ask: are those videos in the part of the blueprint series?
Yep.
Okay.
There's an insane amount of videos there, insane amount. But the important point is understanding that if your model is lacking in any of these areas, then that's what you need to focus on. Because from here, the only refinement takes you to this. This comes, or this benefits you once you have this. So all the times I've been passing around on the calls, if you look at them, you will be amazed at why they work. Why did you pull that low? Like somebody asked me, that low, when you put a low on the call and you kept pulling it out and telling us to watch it. And then I watched how we went below it and came back and then all that. Why that low? Time. That range, time. That specific high, time. But by itself, it doesn't mean anything. Because I could see that high and say, I want to buy above it. I want to sell above it. Whatever. But it's the narrative. We're bullish. This is a key level that should get taken in bullish order flow. There's no confirmation that we've taken it. The things down here that should support that run are not printing. So I don't have confirmation. So I don't have entry fractal. So I take a loss on the chin. I'm fine with that. Take that loss. Market does whatever it wants to do. You start getting confirmation that we're going to violate this expansion. Okay, so you go along. It violates that expansion. We're getting confirmation we're going to violate that expansion. It violates that expansion. What do you think is coming next? This. In worst case scenario, some range in here, it's 50% is going to say, you shall not pass. And then it messy, but this is what a model or a process should have you clearly doing one of this. Daily chart, H1 chart, M5 chart, M5/M1. Game over. That's it. You shouldn't have to overthink this. If you suck at narrative, go back to the daily chart. Go back to looking at some economic stuff. Like basics, nothing PhD level. Risk on, risk off. What is dollar doing? Go back to that basics if you don't understand the narrative. Key level, H1. 80% of your key level should come from your H1 chart. Unless you know other stuff, but 80% of your levels should be coming from your H1 chart. there's a delicate relationship between the H1 and the H4, but I don't teach or talk about H1 structure for the last 5 years. And, you know, I've shared why. Then confirmation. Confirmation should come very close to your entry. It could be that when the H1 high gets a close above, that's my confirmation of direction. So then I start dropping below H1 after that. But, you know, it's going to be your confirmation is always tied to your key level. Maybe it's a H1 failed expansion. So you know M5 is going to have your breakaway, your order block or rejection block for that push. That's it. Or you're going to wait for the H1 to show you something, and then it will vary based on your level of confidence and your level of your risk appetite. Some folks are getting in down here and playing that and selling that. Yeah, you've seen them, but that's not the point. The point is that they are doing this, nothing else. So go back to, like, this is where you have to analyze yourself, right? And this is how we close the call. Get a notebook, or you have your journal, whether it's electrical or not, electronic or not. Assign up 1 page to each of these. Minimum 1 page. Narrative. And you write down, how do I frame narrative? And then you write it below that. How do I frame key level? If you can't write out that process without seeing a chart, you don't know what you're doing. Without being able to see and understand what should happen without evidence on a chart, you don't know what you're doing. Because then it means the candlesticks can pull you like this, like a tug of war. I don't have to see the candles. I can say, okay, I just heard the news. We must be bullish. Does that mean I'm going to buy? No, I'm not stupid. The news says be bullish. I'm like, okay, cool. If we're going to be bullish, then it should look like this. I automatically know what my confirmation on my key level should be. Run an H1 low, I can tell you what that's supposed to be before seeing where the actual H1 low is or H1 levels. That's when you know you've found peace with your model. That's when ICT cannot pull you and say, again, with all love, this is the flavor of the month. This is what you should dig into. I make a whole lot of reference to ICT because I love ICT. I want you to understand that I love ICT. ICT made me into the trader I am. But it wasn't from constantly watching ICT videos that made me who I am. He taught me how to think. Month 1 to month 4 and diligent study, you cannot mess it up. Unless you're trying to just binge the videos. You could dedicate a week to one video. You have time. You have time. Watch elements to a trade setup and listen to it. And watch how he's saying these are the environments in the market, and in each environment, these are the things to pay attention to. And stop going to the charts and thinking, let me just mark this out because it's a down candle before the move. Then it runs it. I'm like, oh, we've all been there. When I started ICD mentorship, I see you to say, do not trade live. But you can't tell me that because I'm working my job. I'm paying with my salary, which is money I'm losing. You know, it's not like you're getting paid a lot of money. I'm making a sacrifice because I believe in myself. So I need to hedge that bet. I need to make something. If I could make $50 a week, that was good. That was paying for ICT's mentorship. But I'd already had a system where I was covering bills. I switched my phone to postpaid, and that might not sound like a big deal to you. But in Jamaica, you're either postpaid or you're prepaid. You're prepaid, you have to go buy the cards to get the credit. Call credit or talk time, whatever you call it. And if it runs out on you in a trade, then you better find the closest card seller to get that top up. So I'm not doing that. So I said, okay, switch to postpaid. Trading is covering the phone bill. Trading is covering the phone bill, and I'm known. Let's say the phone bill is like it's still like $4,000 Jamaican, which is like $30 for you guys, most of you guys. So let's say I need to make $30 for the month to cover my phone bill, and I'm scalping $10 per trade. Before the month ends, I'll probably make a little over 100. So if I'm pulling just enough to cover the phone bill, that's accumulating on the side, the residue. So then I'll say, let me add another bill and another bill and another bill. And then before time trading covered all the bills. Now you start saving your salary. Now you start getting big headed. Time to start investing. That's what I did. So I started buying stocks, and then slowly but surely, compound interest started to show you that it's magical. And then the subscription stuff started. And then the subscription stuff kind of boosted my stock portfolio. Realistically, when the subscription started, I just put that money into stocks. Trading already covering the bills. I have a salary. I'm going to buy a Lambo and then post it. Kidding. I did the smart thing. Stocks. And then slowly branched out into local businesses until, yeah. But yeah, we'll talk about all that stuff another time for those who are interested.
Kish.
Hola.
Okay, sorry. Just for the mechanical guys, just 1 minute, please, if you don't mind. So, just talking relatively to narrative. If, for example, I see in my data that, all right, let's say about 90% of the time, if we are opening below ONS low, we would go to ONS and I, just 90% of the time. Is that narrative in this? Because I understand, okay, because for me, I'm thinking about it that, okay, I know that based on the fact that we would go towards a level about 80% of the times over the last 5 years data, that's what it says. Is that enough for narrative? Because I know that, for someone like me, part of the struggle is that I cannot see discretionary, not that I've not tried, but I just see that it's not my strength. So owning to my strength. So I'm asking, because that's part of the thing. So if my data says we do this every day, 80% of the time, is that narrative, for example? And additionally, the second question would be, how can you teach one to be a good loser, if I can put it that way, to accept the losses and come back tomorrow and to do it again and again? There was a time you once mentioned that you have this feeling when you know you are going to blow an account. Now now I know that feeling too, so I run away.
So thank you.
Okay.
Thank you. All right. So first question is, if your mechanical model is ONS derived, it has nothing to do with narrative, and that's fine. Most mechanical models don't incorporate narrative, they incorporate win rate. Fact. Not like that's not fiction, that's fact. Because most mechanical models and bots don't account for the climate. It's does this fractal print, or does these process take place on any, the complicated ones would, but I'm not thinking yours is super complicated. ONS low taken, CSD, entry buy, good. There, that is. So I'd say narrative has nothing to do with ONS and M5 chart. Your understanding of what ONS does can create an understanding for you, and you don't need narrative. But that's your process. This is generic for what a neophyte would start out with. If you've moved beyond needing this, because what you get from here repeats often enough, that becomes a hindrance.
Okay.
But that's because you're mechanical. So there are levels to proficiency. Literally, there are levels to proficiency. But each level is a strength. You could read daily charts, swing trade. You could read H1 chart, intraday or swing. You could read M1, M5, scalp or intraday. I've tried to make myself into a swing trader and it did not work. That's not me. Second thing is, there is no fancy mechanical way to explain how to be a good loser. It's all psychological and it's all dependent on the person. Full stop. And let's start off with the points that everybody hates the most. Paying for a mentor or a course, right? Most persons don't think that you need a mentor or somebody like that when all information is free and online. I agree. In the beginning, I was like that. It wasn't because of the money. It was just because it wasn't a sacrifice I was willing to make. Making mistakes and then hearing more experienced persons explain how I could fix those mistakes showed me that I lacked something. I lacked experience. So for me, a mentorship isn't teach me how to trade, give me signals. It's show me what you've learned over the years. Sometimes it's simple as the definitions. Sometimes it's as simple as psychology. Sometimes it's money management, depending on the mentor's strength. It will vary. So the first thing is whether you consider your investment into a mentor as a loss or not. That's going to impact your relationship with that mentor. That's the first thing. Second thing is, how much money are you putting into your trading account? Are you getting paid 100,000 and then putting 90,000 because 10,000 covers your bills and then hammering away? That might not be the way to go, because leverage makes us forgiving. So you started trading a small account. The moment you saw $10 or $20 drawdown, cut it. Now you're trading 100K. The market's now moving against you, 10 points. So scrap that $10 idea. You're trading a small account, it goes 10 points against you, you cut. Now you're trading a bigger account, still 10 points. You don't cut because it's $1,000 and it's $100,000 account. It gets to you. It gets to everybody, not just you. It's not talking to you specifically or anybody specifically. It gets to everybody. Everybody does it. You become more forgiving, but prop firms have rules. When you will hold a trade longer than you need to, like Qbanks, you can't do that on prop firm. They will email you. The risk team will say, hey, listen, you do this again and we cut you. Once you get to live, if you think the challenge rules are a pain, when you get to live trading with any prop firm, if you're aggressive, they will email you and say that the risk team has assessed you and said that you are not fit. You need to cut your lot size. You go through stuff like that. That's a loss on your part because your system is built on being very aggressive and scalping a lot. But you have to live with that loss. So there's the mentor that you have to pay for, potential loss, the money you have to put in your account out of your pockets, potential loss, the restrictions or barriers to entry. Folks in America can't use some prop firms, potential loss. Futures versus CFDs, another potential loss. And then comes the daily P&L, which is probably what you're targeting with your question initially. Losses fall into a couple groups. Rule-based, not rule-based. Rule-based losses, I can live with. Not rule-based losses, can't live with those. Those are the ones that hurt. So if you're taking 3 setups every single day, and you're winning one of those setups every single day, and you're closing the day green, you don't care about that loss. What you would care about is how much money you make and not the compounding factor, because you're human. That's it. But if you think about it, taking 3 trades and winning one of those and ending the day green, come on, man. That's a green day every single day with one winning trade. What I would say is if you realize that that's a consistent thing for you, every day, your first 2 trades is a winner and the third trade is a loser. 6, 7, 8, 9, 10 months straight. You win the first trade, consider stopping. You win the second trade, Man, go outside. Go outside. Don't even think about the third trade. Start by finding, like, look at that, stopping the bleeding. Losses, are you bleeding out money? Stop the bleeding. If you realize that every time you get stabbed, you bleed, stop getting stabbed. Like, stop getting stabbed. London guys is a little bit harder for you, but stop getting stabbed. That's it. So you have to look at, if the losses are losses I can take, it doesn't matter. If you realize that losing streaks are happening, then the mature thing to do is to cut the risk. Cut the risk, walk away from the chart. For me, I've shared this before, but I'll say it again. For me, my wake-up call came from moments where I used to flip accounts a lot. Like, I'd flip accounts to ridiculous stuff. And there were times when you're trying to flip and you fail. You know, that's logical. Most times it would come from a good Monday, a good Tuesday, a good Wednesday, a good Thursday. Then one of those TGIF Friday just refuses to slow down, and he just hold in the position for too long, and then the PM session just spikes and you lose all your account. That's happened to me before. I've watched my account just go because I'm holding for too long. And it's usually on a Friday. So then my weekend will be shitty, and I'd say, you know what? There's no way I can win 4 out of 5 days and end the week green. That shouldn't be possible. So I started cutting out the PM session out of my trading. So you'll notice I'm not very active in the PM session, particularly after 2 p.m. It's not that I can't trade or I can't read or the fractals don't print. I know myself. So I'm not doing it. I will play around a couple times, but no, not doing it. Then comes the days when, instead of you know that time when the first time you get back into trading, so you suffer a loss and then you go through that psychological roller coaster. I'm not doing this again. I know better. Why me, God? All that. And you go back into you I'm telling you, like, then you refund the account. You start off the week. Okay, since taking a whole lot of small trades means I don't get enough money, and then the one loss is usually big, I'm just going to go in big. You go in big. No, wait. It's not the moment yet. You go in big, you take a big loss, but no, because the loss is big, you can't compound that. So you're trying to be rule-based, so you walk away. Next day you come back, you make it all back plus more. You're like, hold up, wait a minute. Did I just trade less and make more money? No, I didn't. Nobody tell me this before. So now you start trying to stop the bleeding in a different approach where you just walk away from the charts. You win, you're up, you uninstall MT4. You win, you're up, you go into a different room. You don't watch anime or movies on the laptop anymore. Well, I have one laptop. I don't have a million like you guys. I just have one. So usually after trading, I'd listen to music or catch up on some comics or something. You start moving away from the source of the pain. One loss at this PC, I don't want to see you until tomorrow. Goodbye. You go into a different room, you watch TV, you do whatever. You go outside, whatever. That starts slowly giving you something to do between trades. And then that conversation that you have between those trades, whether it's winning or losing, starts to mold you. You start seeing that, relax. And then you start walking away from the charts when you're up because you're at break even and you can't lose anymore because you've taken partials. Then you start to realize that there's a different side to trading than hopping on the chart at 8 o'clock and then walking away at 4 o'clock. Eyes burning like, you know what I'm talking about. And then you start to realize that, okay, I can actually control my participation. I can control my involvement. Review your journals at that point, and you realize that. So over the last 6 months, I won a lot of trades and I lost a lot. But most of the losses seem like they're happening between 7 o'clock and 8 o'clock. Live, this is from real experience. Most of my losses are coming between 7 and 8 o'clock in the morning. What the hell am I doing? I'm not going to trade 7 and 8 o'clock anymore. You stop. Losses stop happening. You literally start cutting out losses. Now nobody can talk to you. You've now reduced your losses. Your P&L starts looking better. You start withdrawing more. You start appreciating the money. You start getting yourself gifts and stuff and whatever. Over time, you will continue identifying those things. I don't know what they are for you or for everyone, but for me, it was trading out of time in the morning, right when I open my eyes, trading on my phone before I look at the PC, trading in the afternoon because it's Tuesday, right? There's some stupid stuff. And then I slowly started to create rules and break them and create them and break them. So I built a support team. I don't have an accountability partner. I don't talk to a lot of persons back then about trade. So I went to my spouse, say, listen, if you see me trading in the night, just say, remember your rules. Happens, she cut that out. And then one of the biggest struggling points for me, as far as losses were, I used to get text messages from persons before I started trading about trading. So before 8 o'clock, persons used to ask me about what I think about setups. And that would pull me to the charts. And then, oh, that's a nice setup from that guy. Let me see if I can catch a piece. Nope, losses. Oh, what am I doing? So then identify the source of the losses first. When I was younger, I read a quote. I don't know if it's a quote or a book that says, you cannot solve a problem from the same frame of mind that created it. So you cannot be focused on your chart and losing, and then at the same time, you're trying to fix that loss. Just step away, fresh perspective. And all those are the psychological books from way back when start popping up, and I started understanding what they were trying to say in terms of some little quotes and stuff. You fix the loss, fix the loss. It's easier than you think. Just walk away, just stop. Then your day started ending earlier, and you start keeping the money that you're making. And you start to realize that I might actually be able to do this if I just stop this or stop that. And then it just happens. So knowing yourself as a trader is important. People say that a lot and they make it so vague and mystical. Be aware. Sometimes your journals, even your trading journals, does not have to include trade executions. I've had trading days where my journal, I did not talk about whether I took a trade or not. My trading journal literally was, I woke up today, how I felt. I felt clear looking at the markets. I felt clear finding what I wanted. I didn't feel tired or anything like that, or it was a day where I felt tired and all that. And you slowly start to, when you review your journal, you're seeing a pattern. Most of the times when I'm journaling like this is the type of results or this type of money I'm making. So you just start cutting stuff out slowly but surely. It's easier than you think, but you overthink it because you don't give enough light to it. You don't acknowledge it's there. I have a problem. It could be overtrading. It could be you plan to take 2 trades today and there were 2 killer trades, but the market hasn't reached the drawn liquidity as yet. So you're like, why not? Take a loss, it's compounded. Damn, no, you're down for the day. If you journal that the plan for the day was to do this, but I did this. This is what happened. What I'm going to do is do this. And what you can do if you if you have somebody that you're good with, Telegram has this thing, and I didn't know this until my spouse showed me, where you can send timed messages. It was the best thing I've ever seen. I don't know why I've never thought about it to share this before. So my history, and I'm going to start wrapping up the call now. My history has showed that if you have a bias from the morning session and your drawn liquidity is not met at noon and your trade is not at break even, you take unnecessary losses. Kishane, me, I take unnecessary losses whenever my drawn liquidity is not met by noon and my trade is not at break even. I take unnecessary losses. So I spoke to my spouse about this, hey, I'm trying to fix this with my trading and that. And she's like, you want me to send you a message at 12 that says you should break even? I'm like, yeah, that would be cool. But then at the back of my mind, I'm like, I feel like I'm troubling you to. She's like, no, that's fine. I can just I can type the message now and set it to be sent at that time every single day. And boy, that used to come in like trading alerts. It was like someone looking over my shoulder while I'm misbehaving. Hey, stop. And that fixed that issue. So now I don't have trading issues that are monsters anymore. I don't. Any day I feel like I don't feel optimal, I just don't trade, or I trade later, and I don't worry about what I'm missing out. I don't doubt my ability to find a setup in any market on any single day. That's the peace of mind I have now. I don't doubt missing moves. I don't. Nope. I don't try to catch 100 points anymore. When was the last time you saw me with a screenshot where I was 3 days in at break even? Quite a while. I put all of that behind me. I'm focusing on just my strengths, compounding, and letting that do the rest. But I think we did a lot today.
Thank you so much.
Please, one last question before you leave, please.
What's that?
Please, and at a fair value gap, let's say a breakaway gap, a bullish breakaway gap, when the gap is filled, it's assumed price has changed to bearishness, if I'm not mistaken. In a situation where you have CSD happening at a particular level, both sell side CSD and bullish side CSD, which one do you go for, the first or second?
If I have a bullish CSD, so let's say we're looking at this down candle, price trades above it high and then straight above this low. How do you find out what you're going to do here? Something like that?
Yes.
Narrative.
Yes.
Narrative. All right, let's use this example, right? Everybody remembers this chart when it was looking like this.
Okay.
When we started the day, I had, I believe, this FEG here framed out just above overnight sessions low. We wanted to see that tap on and run to here. Cool. We're bullish. We're expecting that high to get taken, the daily high. But this is a breakaway gap. I'm bullish and a bearish breakaway gap is showing up for work. What am I going to do? Easy peasy. Why? Because even though I'm bullish, the narrative here is not saying this delivery is bullish. You reach into something, if it invalid, see if we closed above here and then it crashed and I took a loss, that's it. I can take that on the chin. But when it prints like this, no. So I remember in the real time when this hits here, I said, if you're holding, you have to manage. This is not when you get hopeful, like, oh my God, it's 6-8. I'm up 150 points or I'm up 100 points. This is not the environment for that. We haven't even closed above that. So this shouldn't catch you off guard. If it retraces hard, then okay, cool, yeah. Didn't expect that retracement. But not getting above here when it didn't close, nope, not surprised at all. So you want to spend more time with where your H1 key levels are and where they're trying to get to, and you won't be worried about flip-flop bias. You almost never see me flip-flop my bias, because once I read this in real time and it says something, that's what I'm sticking to. Once I stick to that, I know what I should see that supports it. If I don't see it, okay, that's fine. It's a loss, it's a mistrade, whatever. Tomorrow is another day.
Hey, Kish, one question about bags.
Mm-hmm.
I noticed in some of your examples, you catch a lot of the wicks inside bags in your trades. Can you talk a little bit about the rules that you have that allow you to do that so consistently? Because I feel like there might be something I missed in terms of how you are able to do that so often.
Did I cut out again?
Oh, did you hear me or no?
Oh yeah, I heard you. I cut out.
Yo, no, you know.
Oh man.
I think his laptop battery died. Who's trader?
That yet? Laptop died.
Who is trader? Expose him, please. Something about the way you annotate and the way you say certain things. I feel like I know who you are, trader, but I don't know who you are. Expose yourself.
Maybe he's really a cash low key or something. Huh?
Nah, it's not Cash. Cash doesn't annotate like that. I thought it was Sniper for a second, but trader and Sniper was in the call at the same time. So, who's the host? Who got made the host if Kish cut out? Some guy called Parker. That the whole power of the call is in the hands of someone that I don't even know who it is.
Where is Sniper?
Trader isn't Sniper. He isn't. I've been trying to find out where Sniper's gone as well, bro, but I don't even know, man.
You say the power cut.
Yeah, the power cut. Did he really, or was the question too saucy and he ran?
Yeah, but no. He said he had a power cut. So if it's best to whosoever is the host should end the call, so the recording can be finished and then he can upload it.
All right, so we got to all make sure Parker ends the call properly. Parker, don't mess this up now. Don't know who you are, but the power of everything is in your hands.
You're now Thanos.
Parker.
Peter
Guys,
Parker.
Parker's not responding. This is a problem.
Parker's not paying attention.
Nah,
Gentler's the host now. Gentler's gonna own it. Yeah.
Gentler,
Gentler.
we got saved by a familiar face. Gentler, do the right thing. No sneaky behavior.
Well, it all depends on the mood Gentler is in.
Oh, gosh.
I'm feeling